Let's talk about the proposal from President Trump around the 10% maximum on credit cards. We're going to talk about consumer confidence and what happened this morning. We'll talk about the chances that China has just turned on the money printer and it goes burr. We'll talk about Michelle Bowman and why she dissented. We'll also look at what Austin Goolsbee had to say, both Fed presidents. And finally, we will get the latest on home prices. But first, folks, let me do something I should have done weeks ago and congratulate Ashley. Ashley, congratulations for getting your golden ticket. I apologize for not giving you recognition. It got lost in translation. But Ashley, congratulations on getting your golden ticket. You did the work. You earned the card. And there you go. I apologize for missing that one. While we're on the front of congratulating folks, let's congratulate Cindy. Cindy actually got a couple of tickets. She closed on another house hack and another deal. So Cindy, congratulations. Ashley, congratulations. All right, folks, let's get into the news. I've heard a lot of people talk about this proposal that capping credit card interest rate at 10% is a great idea. I'm neither here nor there. I haven't carried a credit card balance since my early 20s. But I do want you to realize there may be some unintended consequences. If you force credit card companies to a maximum interest rate of 10%, I can pretty much guarantee two things will happen. One, less people will get credit cards. And two, credit limits will be smaller. Folks, at the end of the day, credit card companies have high interest rates because they are trying to manage the business of giving folks credit. Some of those folks will not pay back, will be discharged. And thus, if you are forced to lower what you can charge, i.e., price fixing, you are going to have less available credit and you will have less people with credit cards. So again, not here nor there, not talking about whether it's a good idea or a bad idea, but at the end of the day, realize that there are some significant implications if interest rates are capped at 10%. All right, folks, we got some economic numbers this morning, and they were ugly, horrible, nasty. And unfortunately, it's a pretty important metric. It was consumer confidence. Consumer confidence is a monthly metric that basically highlights what the consumer feels about today and the future. And consumer confidence fell the most in the last 3 years. Consumer confidence last month was 105.6. It was expected to go down slightly to 104, and it crashed to 98.7. Again, when you look at the consumer confidence, it was not a rosy picture in the current environment, and I would argue was worse into the future. It does appear that the consumer confidence is really starting to highlight the weakening labor market. And again, what we have talked about on this channel for 6 to 8 weeks is that the end of the year was going to be slower. We are having consumers pull back. When consumers are scared or fearful, they pull back. We are seeing this in housing. We are seeing this in autos. We are seeing this, frankly, in nearly all retail environments. So again, consumer confidence, not good. Again, fell the most in the last 3 years. What about what's going on in China? China announced almost unheard of stimulus. And again, China over the last several years has been dealing with a weakening economy. They basically destroyed their real estate industry. Their real estate industry was how the Chinese citizens really set up their retirement, and they lost faith. So consumers have been pulling back. There's a lot of debt overhang. There's a lot of bankruptcies. Frankly, a lot of pain. What did they do? Well, China, in a bazooka, came out, lowered rates, and said that more rate cuts are coming. They cut rates on existing mortgages. They cut rates on existing mortgages. They eased rules for second homes. They lowered bank reserve ratios, how much cash they have to keep. They announced a supportive $100 billion equity market support program. And finally, there is talk of a stock market stabilization fund. So again, you could hear the printer or series of printers in China being turned on. The question that you and I have to ask ourselves is what happens here? I think it's going to be very interesting to figure out, because again, what you are seeing over in China is the consumers who were in the housing market got severely hurt. The builders who were leveraged in the housing market got severely hurt. A lot of these are trying to spur demand, right? Lower rates, easing rules, all of that. But if the consumer psyche is broken, this will have very little, if any, immediate impact. The one that I think about the most is actually the second bullet. They cut rates on existing mortgages. Now, again, I don't know how this would work. I want to go get some more details on this. But in theory, again, just reading that line, think about this. You have a mortgage. This would have to be maybe a government-backed mortgage, FHA, for example. You have an FHA mortgage at 6%, 30-year fixed, 6%. And something the government does because they want to create stimulus, they want to create some more velocity of money in their system. They mail you a letter and say, congratulations, we have just done an automatic rate adjustment on your loan, and it's gone from 6% to 2%. I don't know about you, but I think I'd like that letter. So again, I don't know if that's exactly what's happening. I don't know if this is maybe rates on new business, but again, it is something to think about. I don't think there's any question China turned on the bazooka for stimulus. But what does it mean for us? A lot of that debt that is problematic in China is held by China. There's very little kind of offshore of that. There are certainly some, but it's on a percentage basis small. What I wonder is, once the money engine, the printer gets going, and it won't be instantaneous, it'll be months from now, does the smart money start to take some of that increased velocity of money and move it out of China? Or does this start a reinvigoration of construction, perhaps? I don't know. So I think of a couple of things. What I would be doing is watching raw material, aka commodities, copper, cement, steel. And then I'd be watching gold. Again, we are seeing today, Peter Schiff is posting almost daily. Gold is at a record, another record high. It does seem, we have a lot of things going on, and the fear trade is back. So gold is something to watch as well. So again, don't know where this goes. If China's turning this on, we just heard from Germany and now France that the Europe market is in trouble. Everybody's on a rate cutting cycle. Where do we go from here? And how fast do we get there? All right, folks, let's talk about Michelle Bowman before we talk about Austin Goolsbee. Michelle Bowman, again, the lone dissenter on the Fed Open Market Committee last Wednesday. She wanted a quarter. All other 17 wanted a 50, so we got a 50. I do want you to highlight how unique this was. This was the first dissent since 2005 on a rate cut. There have been other dissents since 2005, but never on a rate cut. Again, first dissent on a rate cut since 2005. So what did Michelle Bowman have to say? One, she thought a 50 was premature declaration of victory on inflation. Number two, she thought a 50 would give Wall Street or the smart money or the market the expectation that our cuts going forward would be 50. Well, Michelle, I think you're right. I expect a 50 in November. I think your peers are telling us a 50 is coming. Number 3, if rates fall, cash on the sidelines might be put to work. Again, folks, we have seen one of the first things that happens even before mortgages is savings rates have been declining. So again, when does that $6.4 trillion in money market accounts come off the sidelines and go to work? Maybe it was happy earning 5%, but is it happy earning 4? Is it happy earning 3.5? Is it happy earning 2.8? Don't know. At some point, that sideline cash will likely be put to work, according to Michelle Bowman. And then finally, probably the most important line for me is Michelle Bowman believes that the neutral rate, or what is often called R star, is higher than her peers. Right? We have heard from many Fed presidents, Bostic and others, talking about R star, the neutral rate, being around 3.25. What Michelle Bowman has just told us is she's like, no, it's higher than that. Now, she didn't give a number or a range, but hey, let's just call it 4%. That's a meaningful delta. That's 100 basis points delta. So we will see how that evolves over time. All right, what did Austin Goolsbee have to say? Austin Goolsbee said, we are hundreds of basis points above neutral. Again, hundreds being plural. I think this really does point to the neutral rate being 3%. It also makes me feel really good about my call for 50 in November. Rates are way above where anybody thinks neutral is. This is probably a shot at Michelle Bowman that, everybody agrees that neutral is not 5.25. So we are a long way away. We have a long way to go down, and he wants to get there quickly. Warns of rapid deterioration in the labor market. Again, folks, we have gone from a Fed who is data dependent, meaning looking backwards, to a Fed that is looking out the windshield going, oh my God, it's getting nasty out there. Can't be behind the curve and get a soft landing. Again, there is still hope of this mythical soft landing a la 1994. And then finally, this one was interesting. You know that I highlighted this earlier as one of the reasons the bank may be afraid. We must ensure that banks' provisions for losses on commercial real estate. Again, one of the things that I pontificated is the Fed out there trying to somehow neutralize or lessen the commercial real estate catastrophe. Again, what they could do is if they could lower rates, they could potentially lower cap rates. Lower cap rates increases value. Increases value means less losses for banks. So again, there are lots of things going on out there. Again, more Fed speeches this week. I think we still have 10 or 11 to go. Definitely market moving. Definitely need to pay attention. So it will be fun to watch. We did get CaseShiller and FHFA home price data today. Again, as always, remember this data is very, very much backwards looking. We are at the middle or end of September, and the data I am about to read are from July. So again, CaseShiller, folks, drum roll please, up nearly 6% year on year. Total was 5.92, up 3.3% month on month. Yes, folks, no housing crash here. It is interesting to point out that last month, CaseShiller was up 6.47. And again, remember, it's up 5.92. So it is slowing down. It is less up, whatever you want to say. Remember what I called very early in the year, I see real estate being flat kind of year on year. So we are seeing housing come in. It would not shock me if we ended the year flat, just like I called at the beginning of the year. What did FHFA have to say? Well, they highlighted that home prices across the country were up 4.5%. They also highlighted that was the slowest since June of 2023. Again, it would not shock me if FHFA and CaseShiller continue to show slower home price appreciation as we get to the end of the year. Folks, we are in a buyer's market. We have consumers that are scared, pissed off. You've seen consumer confidence fall. We have a lot of things going on in the economy. It'll be very interesting to see where we are January, February. Elections behind us. Rates are down somewhere between 75 and 150 basis points. Are we in a nasty recession with unemployment over 5? Is a soft landing still hopeful? Are we having the classic rolling recession, as I've talked about? So again, lots of things to look at here. Let's give a shout out to Mike Simonson. He did post his weekly report on the active listings. Let's run through that. Active listings were up to 725,000. That is 37% year on year, up roughly 10K week on week. Pendings really slowing down, only 62,000 this week. So again, inventory building, days on market growing. It is your job, your responsibility to find motivated sellers. I do want to shout out 2 videos that went live yesterday. Jason Pritchard, one of those investors I put on Mount Rushmore of my real estate investors. He just shared with us that he made $229,000 net in a single month. Go ahead and tune into that video, see how he did that. And then more importantly, Taylor from Life Goal Investments, 12-year Wall Street veteran, was nice enough to join our school community, talked about portfolio construction, talked about the Fed, rates, recession, all of those things. Those videos are live and available for you, folks. And then lastly, we did have 3 people join school. Pam, Wade, and Joe. Thank you for joining school. Make sure you introduce yourself. It is a wonderful community. Again, I am on a mission to become the #1 school platform for real estate investors. As of today, we are number 4 out of 1,200. Again, we are number 4 out of 1,200. I will not rest until we are number 1. What I need from you is we need to get some more members. We need to get some more interactions. And yes, I need to provide more and more value. Folks, I'm working on it every day. Have fun. Take care of yourself. Like, subscribe, comment. Later.